Netflix, big company, big name. It's caught the consciousness of the market. Obviously, here today, it's breaking out of a year-long range. Hitting an all-time high after their earnings reports. I know you dug into these numbers, and there's some unpacking here we've got to think through. Matt, give us the data that you found.
Yeah, a couple things on Netflix very quickly. And when we talk about the importance of the market, this is the market today. Netflix is the market today. It's really kind of it's the market showing you the cards to a certain extent as well, and we'll get into that here in just one second. But let's get through some raw numbers for a second. And I was talking about this in the pre-production show with the team. I said if any new trader needs a little micro lesson on what is important to the market, past performance or future expectation, Netflix is showing you what is important to the market today. Netflix's raw numbers were not good, and that needs to be said. They were not good. Now, they were not bad. They came in right in line. They came in line with expectation. Now, a growth company like Netflix, that is typically not very good because you want to see beats on EPS. You want to see beats on revenue. You want to see these types of things. You want to see revenue year over year increase 30, 35, 40%. That's what you want to see in a growth-based company like Netflix that has not been cash flow positive in the last 15 years, right? This has been a debt-driven company that has spent billions upon billions of dollars in original content, which has paid off very handsomely for Netflix, mind you, very handsomely for Netflix, and to the point where literally Reed Hastings was throwing some shade to a certain extent at Disney for pivoting to compete against what Netflix is doing. And Reed Hastings deserves that little shot against Disney, quite frankly, because Netflix got a lot of heat for many, many years about how many billions of dollars they were spending on original content. And people were making fun of all these millions of dollars they were throwing at, comedians and entertainers and to create their original content. But that is paying off very, very handsomely for old Reed Hastings and Netflix in general. So let's look at some of the raw numbers. They missed on EPS numbers. They came in at $1.19 versus the expectation of $1.38. That's a bad miss for Netflix, quite frankly. Now, especially given the backdrop of last year, revenue came in at 6.6 billion versus the expectation of 6.6 billion. So again, came in right in line with those revenue projections. Nothing to see here there. Again, you want to see big time increases in revenue projection, not revenue projections, but revenue performance. But we didn't see it this quarter. It came in right in line with what that expectation was. So what is driving Netflix? If it wasn't past performance, and it certainly was not past performance today, what's driving Netflix? Future expectation. Here's a couple things. Number one, big time increase in guidance. Big time increase in guidance. They came in at $1.97 on EPS guidance. Expectation was, they came in at $2.97 on EPS guidance. Expectation was $2.12. Massive increase in EPS guidance. Revenue, slight increase in revenue guidance up to $7.12 versus $6.89. So that future expectation is really driving that Netflix. Also, Netflix announced that they're most likely going to be cash flow positive by the end of the year. That's big time news for a company like Netflix, a debt-driven company spending billions of dollars on original content, putting money into their company. Now they're going to be looking to be cash flow positive. And the biggest kicker here, and a little bit of surprise and something I do disagree with on Netflix, but again, the market is celebrating it today. With that expectation of positive cash flow from on Netflix by the end of the year, they're looking at the potential of a stock buyback program for a massive growth company like Netflix. Now, again, we can debate whether that's wise for Netflix or not. I do not believe it is. I think that is a mistake to do to this early in Netflix's life cycle to start rewarding the investors. I think they should go the Apple route and build a cash arsenal to where they can be seen as more of a utility base that can withstand anything negative that comes at them versus, say, using their cash flow to put it back into price appreciation. If you're going to reward your investors, do it in a dividend first. We don't need to do the stock buyback. Go do a dividend first, and then you can reward the investor. So I do disagree with that. But again, the market, even the hinting of a stock buyback program is a massive boon for the market because we know how much that helps price appreciation here. So Netflix's massive increase in guidance, couple that with a potential stock buyback program here, you also surpassed 200 million subscribers for the first time in Netflix's history in this quarter. So you achieved some milestones that the market certainly loves to celebrate. Over 100 million subscribers, over 200 million subscribers. Subscriber growth looks very impressive for Netflix. Their guidance looks very, very impressive. And overall, you look at what they did, kind of nothing to see, kind of like their stock's done in the last 2 quarters, nothing to see here. But what they're expecting to do is very important for a growth company. And especially given the backdrop of last year, everything kind of shifted from what have you done to what will you do. Netflix kind of embraced that here today. We've done a little bit for you, but we're going to be doing a heck of a lot more for you in the future. Netflix blowing out of their earnings report. Now, what is important to me, their numbers are what the numbers are. People are celebrating the future expectation of Netflix here today. What is important is to understand this gapping range and whether or not we're breaking out of this 6 months in consolidation. And the reason I bring that up is over the last year and a half, 2 years, if you'll give me a little bit more data, you've had Netflix have that. They had a good year of consolidation. And if you'll switch it out to a weekly chart really quickly, you kind of see that breakout on that positive earnings report from from literally, I would say it's April of this year, that first report after the pandemic kind of hit us. You had a lot of wide range neutrality in that over a year as well, ranging from 250 all the way to 400. You broke out of that wide range neutrality on a very positive response to an earnings report. You saw very good appreciation after that from 400 to 550, up north of 550. You're seeing something fairly similar here today. Obviously, you may not chase it given the price performance today, but from a weekly perspective, wide range neutrality between really kind of that 460, 470, and 580 barrier, is setting up some fairly decent support and resistance zones. You're easily breaking out of that here today. Netflix is something to keep an eye on.